When I saw that live presentation back in 2015, I was introduced to the concept as codified, discovered, and described in the Becoming Your Own Banker book by the man, R. Nelson Nash. So my strongest encouragement educationally, beyond our material, which we put out a lot of best practices, case scenarios, real life examples, lots of content, is to get into the original material for yourself. It's all in the name, Becoming Your Own Banker. And that's what we do. We teach people how to do what we've been doing personally in our own private lives for going on 10 years now, going on a decade now, creating this private banking system. What I generally have in mind, now that I've kind of put out some of those prefacing comments and suggestions and recommendations on getting in the book, watching our introductory presentation, booking a consultation call if you haven't yet. And even if you have, this is always a good reminder for clients. We've got bunches of clients all across the United States. You need to always have your next phone call in the funnel, in the works, whether that's 6 months from now or a year from now, that's fine. Some people like a closer connection. Some people, they're out there touching base once or twice a year. That's good too, whatever works for you. But having something in the pipeline where we can share best practices is always helpful. The general idea that I had in mind to share today is the macro level view. We can get as specific, as granular as anybody wants to, but the macro level view, the 30,000 foot view, as they say. And I imagined it playing out in this fashion. Do you remember in school how you would learn about writing a paper, let's say, and you would consider the who, the what, the when, the where, the why, the how? And those are all very relevant questions when it comes to our money and our plans and goals and aspirations and things that we want to do and accomplish. Makes sense to me. So I thought about addressing the who, the what, the when, the where, the why, the how when it comes to infinite banking. So let's start with the who. There's this guy on the back of the book, for everybody that can see that, R. Nelson Nash himself, who discovered the concept of an individual becoming their own banker. So those are the relevant who's, the people that are here, the people that are showing up, the people that are asking questions, watching, again, whether that's now or in the replay. Either way, that's the who. Now, there are other actors in this play, and that's worth noticing. Let's point out a couple of big ones that we talk about regularly and that Nelson does in his book. One of the big actors, we're the main actor. We're the main actor, obviously, in our lives with our money. But one of the other big actors is banks. One of the other big actors is banks. That's not something that people think about beyond making sure to have direct deposits ready every Friday when they're paid, or running to the bank to get some cash out. That's been a real relevant subject in my part of North Carolina here recently, where people have had emergencies come up because of, and let's go ahead and talk about that. Emergencies come up because of a hurricane coming through, and systems are down, computers are down. I would point out real quick, I know I'm jumping the gun even by mentioning this here, because I'm introducing another actor sooner rather than later, but whole life insurance. That's what we teach people to buy and own and operate. And my cash values during this hurricane have done nothing but gone up. I'll just go ahead and plant that seed now while I'm thinking about it. My cash values, whether I had power or not, and I didn't have power for a week, right? And people have had it worse. I'm not complaining. I'm just saying I had no power for a week, no phone signal for a week, no water for a week. Okay. Water supply cut off. We're on a well. We're out in the country. But my cash values went up. Amazing. Amazing. Okay. So let's go back to this bank. The bank is another actor in our lives. Folks needed to go to a bank to get $1,000 out. $2,000 out. Not a bunch, but something for food, something to be able to pay some cash, because that's the only thing that would work with the computers down, system down, signal down, power out, people handwriting out receipts and such. People needed cash to be able to get propane, to heat, to cook, to be able to buy bottled water, to be able to buy diapers. And people I personally know We're getting turned down, turned away, talked back, given excuses about wanting access to $1,000 or $2,000 just to be able to take care of necessities. So I'm just saying that's one example, and there are lots that we could give, but that's one example of another financial actor in our lives that affects us in a big way that we just don't normally think about. We're not taught about banking. Nobody teaches you about banking in school, at church, in home, and it's because they don't know. Mostly they just don't know. People don't know. But we need to be paying attention to banks. And at a high level, just ask yourself this question. Aren't banks the nicest buildings in the best parts of town with the most beautifully kept grounds? Yes. And aren't they on your street corner, my street corner, every street corner? Yes. So there's this very prominent financial actor in our lives, one of the who's, okay, in this series of questions that I just want us to consider, that have their names on the big stadiums and such, the big skyscrapers and such in the big cities, right? And that's just one real life example that we have of the control that that financial actor has over us, over our money. Food for thought. Food for thought. Banks, it's an interesting business. It's a very interesting business. It's a very profitable business, and they have a lot of control. I talked about the control right there just by saying, well, just because you've put $1,000 or $2,000 in the bank doesn't mean that you get to get it right away. They owe you, for sure, no question about it. And this is where people like to jump in and say, FDIC. Listen, the Federal Reserve is neither an actual federal government entity, nor does it have any reserves. Just like that bank didn't want to give that one individual $1,000 or $2,000, because what happens if the next person comes in that town who's having the same problem, experiencing the same crisis, needs $1,000 or $2,000? We'll see if enough people do that. Those banks are not sitting on hundreds and hundreds of thousands of dollars like it looks like from the outside that they would be. No. Now, that's not to say that they're not profitable. Okay. That's just me trying to point out the control that that financial actor has over us in our lives in one way. Here's another way. If you don't have the cash that you've deposited there that they owe you back, then you're asking for loans. You're asking for permission to be able to go out and finance the things that you need, want, etc. So you got to fill out their paperwork. You're going to pay them interest. We'll come back to that as well. If they qualify you, can you meet with their loan officer next Thursday because it's their time schedule, etc. Okay. So this entity, very profitable and has a lot of control over us. So let's talk about the profitability. Let's take that same figure. Let's take that same $1,000. Let's say you've got a $1,000 deposit at the bank. They're promising you whatever the percentage is. We don't have to get caught up there. I don't care what you say. You could say something absurd, right? You could say something like 10%. You could say something absurd. It's not that. It's probably about 1% or less now. But notice this. For every dollar that we deposit at a bank, they're promising us that 1%, 10%, put in that number that you want to there. But the next person that comes in line that they're making a loan to, let's say that loan is for 5%, 8%. Well, if they're paying you 1% and they're charging the next person 5%, aren't they making 4%? It's a good return. Okay. If they're charging 8%, aren't they making 7%? But follow me on this. No, the answer actually is yes, but no. Yes, it could be that difference of 4% or 7%. But if they're paying us 1% and they're charging someone else 8%, isn't the bank earning a 700% return? 800% really, but then they're paying us that 1%. See, banks are earning multiples of the dollars that we're depositing there. So while we're encouraged, financially speaking, when you go out and you invest, okay, and I'm not giving investment advice, but we're told to go out and invest for retirement, right? And the S&P 500 or whatever index has averaged 12% over the past, historically, blah, blah, blah. People are talking about 1%, 7%, 5%, 12%, 20%, while banks are making 400%, 1,200%, 800% on the money that we're putting there. It's huge, a huge financial actor in our lives that we just don't know enough about or think about or we're not taught about. Okay. And that's one big thing that we try and draw your attention to here is like, there's this actor in your life where typically you're either just thinking about being a consumer. You're thinking about, well, I'm going to save money and maybe you put it in the bank. Okay. Or I'm going to spend money. Whereas we're teaching people you could do both at the same time. You could be saving your money and spending someone else's, saving your money, spending someone else's, but you need to know about banks and then more about how to become your own banker, of course. So a big part of the who is you're the main character, banks. There's another actor in your life, and that is insurance companies. Maybe you participate with them and maybe you don't. We encourage people to understand how properly structured whole life insurance from a mutual life insurance company that pays dividends works. And for lots of reasons. They're another great big financial institution. All right. Life insurance has been around for hundreds of years. So talk about longevity, hundreds of years. So much longer. My buddy Joe, he says the 401k hasn't been around long enough to retire itself. Just for comparison. Very interesting. And I love the way that he puts that. Life insurance has been around for hundreds of years. Whole life insurance is a type of insurance that you get to own for your whole life. Wonderful. Your whole life. It's always yours. Amazing. Beautiful concept. And then if it's from a mutual company, well, there are only two types of companies, stock companies and mutual companies. Mutual companies are the kinds where you as a policy owner are part owner of the actual company. And when that company enjoys profitability, which all the companies that I personally own policies with, and I own multiple policies, from companies that have been doing business for well over 100 years. So not only have they been meeting all their requirements, paying out death benefits on these whole life insurance policies for over 100 years minimum, and some of them a lot more than that, a lot longer than that, but they've been profitable beyond that and paid dividends. So you get to be part owner of the company. You get to own this asset for your whole life. It's going to grow and compound guaranteed while you still maintain access to capital. So it's a place where you get to save money. All right, you get to save money by paying premiums to a policy with this kind of a company that pays a dividend. And because it's been built the right way for banking purposes, you get access to a significant cash value over your whole lifetime. And that cash value grows and compounds every day, every month, every year, your whole life. Just like I was mentioning a second ago, when that hurricane came through, whether I had power to check it, whether I had signal to check it, the cash values in our policies grew. What an amazing thing. And then all the companies that I own policies with have paid dividends without missing a single year for over the past 100 plus years. Now just think about that. When it comes to the history that's taken place over the past 100 years, let's start working backwards, I guess maybe would be one way to do it. So think about the COVID era, paying dividends. Think about the housing crisis, 2008, big bubble. Think about the Y2K experience. Where are my millennials at? Let me know. You remember Y2K? You could put something about that in the chat if you want. I still remember celebrating and half wondering what's going to happen with the computers. It sounds wild, you know, everything that they're describing back at the turn of 2000. But Y2K, and then just keep walking back as far as you want after that. Stagflation in the 70s, whether it's Korea, Vietnam, World War II, World War I, the Great Depression, the Spanish flu. Look at all the history that's happened. And not only have these companies met all of their requirements, all of their obligations, met all of their promises, but they've been profitable and pay dividends also. Beautiful. Now, that is a financial actor that's out there in the wide world, but we have to, or not, and that's the point, you can become your own banker. We have to decide whether or not we want to privately contract with such a company. And I think that's wild. Think about this. How indoctrinated are we to as soon as we get a new job, for example, we're filling out that direct deposit form. That way, before money ever touches our hands, not only have we already been dealing with inflation and we've paid taxes on it and we've had all these different things drawn out of it. And then what's left is deposited into somebody else's business, a commercial bank. Before the money ever touches our hands, it's gone through Uncle Sam's hands. It's gone through the bank's hands. We're dealing with inflation like crazy, and that's not going anywhere. What's your best hedge against inflation? What's your current plan to hedge against inflation? It's worth thinking about. Cash flow is so important. Controlling the banking function is so important to mitigating against that risk of inflation. But all of our money's going into that business, somebody else's business. And we just, like in the Matrix, we no question, of course I want to put a direct deposit in that other business that somebody else owns every week. Whereas buying a whole life policy is something that you have to intentionally do, purposefully do. You have to decide, yes, I would like to pay this amount of premium to have this kind of policy that's going to have this amount of death benefit, cash value, etc. And that's just at a surface level. That's just me speaking about whole life insurance generally. We are specifically designing these policies for banking purposes. But either way, it's something that you as a private individual can decide to do or not to do with this company. It's a private contract, a unilateral contract. Now, how we go about doing that, I will repeat that here as I kind of mentioned it, is you get to decide the premium that you want to pay into your policy. Much like you're the one that's deciding how much of your income, cash flow, is going into a bank. You're the one that filled out the direct deposit form. You're the one who, when you get paid, if you go and make that deposit at the bank, you decide that. So you can use a policy like a bank in that way. You're deciding. I don't tell people their numbers. They're going to tell me what is an appropriate amount of premium for them to pay into their private banking system, their policy, how much premium they want to pay into their whole life policy. And it's going to have that guaranteed death benefit. It's going to have that guaranteed cash value. But that's a who that we get to decide to work with. These actors are important to know, and how Nelson has this saying in the book. He says that, number one, we got this problem of misclassification. We don't know who's who. And then the other issue is that we don't know, he says, we don't know who's who. We're misclassifying things and people is one big issue. Let me just leave it there. But those are some of the who's. Us, we're the main character. Banks, they play such a big role in the conventional, in the matrix, in the box financial world. And whole life insurance companies, big player out there. We could decide to play that game. So there's the who, the what. The what is banking itself. And that's something that we illustrate really well in our introductory presentation video. And again, if you've not seen that, that's the place to start visually. I would encourage you to check that out. The what is banking. Banking is going on. And I like to ask people to think about what banking means. What is a bank? All right. And anybody that's here, I'm watching the comment section. You can put something in the comments. What's your definition of a bank? And if you're just listening, that's fine. I don't mind a big pregnant pause here, because that's what I got the first time somebody asked me. I didn't get an answer right away. Now, they just let it marinate there, and I really had to think about it for the first time. I'd never been asked what a bank was before. Somebody asked me, what is a bank? And then they gave me some examples, and I began to actually consider what a bank is. Here were the examples. Food, bank. River, bank. Snow, bank. Blood, bank. So a bank is just a place where something is accumulated. All right. And Felicia says a bank is a place of exchange. Good. You're right. Because whatever the medium is, okay, there's incoming and outgoing, or exchange, like you're saying. So money is a means of exchange. And we accumulate it in banks, for example, and we also deploy it from banks. So maybe I'm putting money into accounts at a bank and I'm taking money out and using them somewhere, whether that's for consumption, whether that's for production, that's its own conversation. But right, it's a place of exchange, a place of accumulation. Like a blood bank has blood coming in, okay, to be able to help people. And that means that it has to go out also. So once we realize that that's all a bank is, it's really only us using some imagination to consider a properly structured whole life policy from a mutual company that pays dividends as a bank. Does money go in? Yes. Premiums. Can money come out when we choose? Yes. Policy loans, withdrawals. Yeah, absolutely. So it's like a bank if you just use some imagination. Now, it's not, but it is, right? It's a whole life policy. Okay. Banking is just a function. Banking is just a process. And a bank is a place where this exchange, like Felicia says on YouTube, is taking place. Money's going in, money's going out. Well, premiums happen to be going into a policy, and the way a policy is designed, and each policy design is different, should be particular to the individual, but the overarching idea is that, well, we're going to use money all of our lives for our whole life. So we want to use whole life insurance because whole life insurance can be paid into for your whole life. And just like we're happy to make deposits in our commercial bank account, I'm happy to make premium payments into my policy. I promise you, knowing that, and here's where we're going to start to get into some of the features maybe about why, the who, what, when, where, why would we put money in a whole life policy? We'll get there in a second. Let me put a pin in that. But the what is banking? Money going in, money going out. Premiums going in, policy loans coming out for things like what I just said a second ago, like paying off student loans, paying off the family car note, paying off credit cards. And then, of course, it could be for buying things. Could be for paying for a family vacation. We've done that. Could be for paying property taxes. We've done that. Could be for business ventures. We've done that. Could be for real estate endeavors. We've done that. So just all these different examples. It is the infinite banking concept. Okay, so I'm just saying when you realize what a bank is, it's just using your imagination to say and realize. It's really just you realizing that a whole life policy has the features that you're looking for in a bank. Well, there are differences, lots of differences. All right, so maybe we should talk about that now. So the who's, all right, us, banks, money, and whole life companies. The what is banking, the process of banking. Money's got to go somewhere. Where should we put it? Okay. And then why? So let's talk about the why. So why would somebody consider becoming their own banker? Why would somebody consider this idea of being able to save and spend your money at the same time? Here are some reasons why I think that it's a worthwhile philosophy, paradigm, endeavor. Okay. Look at the characteristics of the bank. If you were going to describe, if you were going to build, if you were going to make the ideal bank where you're going to put your money, right? Because we're putting them in the commercial banks right now, and I don't need to list the names. You know what they are. We're putting our money there. Do you own that bank? I don't own the bank in my town. So would you like to own the bank where you put the money? Given the option, I'm saying yes. 10 out of 10. 10 out of 10. I'm saying yes. I would like to own the bank if I could own the bank. Great. So you have private ownership with a whole life policy. Beautiful. Now, what happens when you put money in that bank? Okay, because we know what happens when we put money in a commercial bank account. We know what happens right there. We know what we get out of that. A pittance of an interest that we're taxed on. Okay, what happens when you put money in a whole life policy? You get a death benefit. Day one, worst case scenario, heaven forbid, I graduate today, I pass today, I die today. My family gets a big old income tax-free windfall. Day one, that happens. Okay, lots of money to wipe their tears away with. As I heard it described when I heard about infinite banking the first time. Oh my goodness. Guy talking about kids were going to have to try and wipe their tears away with the money. just to be funny about it. It's fun. It's good. But for people that feel the way that I do, that's an important thing. To be able to leave an inheritance to your children's children is biblical, if that matters to you. So you get a guaranteed income, tax-free windfall to your heirs or beneficiaries from day one. Great, awesome. What happens to the capital that you put in there? Does it grow? Yes, it does. Does it grow guaranteed? Yes, it does. Does it grow in multiples, creating a hedge against inflation in the future? Yes, it does. Is it private? Yes, it is. Is it conservative? Yes, it is. Is it safe? Yes, it is. Is it accessible? Can I still get to it? Can I still get to some money? Yes. Yes, you can. It's liquid. So it just begins to check more than a dozen boxes that I'm aware of, okay? Putting money in whole life insurance when it's been built the right way with these kinds of companies by somebody who knows what they're doing because they've personally implemented infinite banking in their own lives, it begins to do more than a dozen things that I'm aware of. It has these characteristics of the ideal financial asset. We're just calling it our private bank, but it's a whole life insurance policy. Just by using some imagination and logic and reasoning, as Nelson says in the book, to see whole life insurance for what it is and what it can be and how it can be used. You mean I can have private ownership on a compounding pool of capital for my whole life that still is going to culminate in a tax-free windfall to my heirs and beneficiaries? Amazing. So that's some of the why, okay, is what whole life insurance or the product or the bank that you choose could be doing that instead of what it is that we already have. We know what we already have. Now, here's what I think is the root of why someone would choose to put money in that place beyond the characteristics that you get by putting money there. If it's just at that level, you mean there's more than a dozen reasons of why I'm going to have benefits by putting money here instead of there? Yep, absolutely. But the point of being able to access capital changes it all, okay? Because it changes from something just having these characteristics that are pretty by putting it on a shelf, like a collectible or something, versus something that you actually get to use for yourself. So I'm not trying to describe, some antique that's going to look pretty on the shelf and it has all these endearing features. No, I'm talking about something that you can use in your regular everyday life. So here's where we got to talk more about banking, more about financing. So recognize something big here. There are only two conventional routes to finance. Either you're going to pay interest to someone else on their terms and conditions if you qualify, etc., or you're going to forego the interest that you could have earned on your money. Did you follow that? You're either going to pay interest or lose the opportunity to earn interest. Those are the two ways to conventionally finance. They're called credit and cash. Credit, paying someone else interest. Cash, liquidating yours. It's gone. You don't have it anymore, and you can't earn any more on it. Credit and cash. Well, the third C is compounding. It's the ability for you to be able to compound on your capital and still use it, okay, for your whole lifetime. So what does that look like when it comes to numbers? Well, Nelson points out in his book that the average American is bleeding out 34.5 cents of every dollar in interest alone. So just, I illustrate this sometimes, and I probably should now. You just imagine, some people, I was a teacher, you get paid every month, some people get paid every week, some people get paid bi-weekly, whatever it is. But imagine you get paid what you get paid, okay? 34.5 cents. Right? The average American is bleeding out interest dollars. That was fake. Calm down. That's why I had to be careful about where I grabbed it from in the wallet, right? No, but you see, I hope that's a good illustrative point to you. A third of our cash flow is paid in interest alone. We haven't even begun to talk about, and I've mentioned these things, taxation, inflation, so much else is going on, but just interest. If we could just take care of that. All right. So you earn what you earn, right? Now just imagine a third of that gone every week, every month. You're just bleeding that out to the banks and everybody else. What if you could keep half of that? What if you could keep all of it? Because you can. All right, so here's something I'd encourage everybody to do. You probably won't do it. Most people won't, but for those of you that will, I dare you, I double dog dare you to pin this to a number for yourself. That's the only reason I think you should do it. Because I believe that if you calculate up your costs, your expenditures, your bills, all right, you go to the home mortgage, you go to the car note, you go to the whatever, okay, look up just last month, just for 1 month, look at 1 month, how much you paid in interest, calculate that up for yourself. What's that total? I dare you to go look at your number for yourself. You'll probably either vomit or get very, very angry. I know I did. And when you realize that that's what's leaving you and your family forever, and that you actually could be keeping some of that, all of that, you start asking questions like, well, Jesse, how many of these can I have? How soon should I be getting started? How big should my numbers be? And you start asking questions like that. And those are good questions to ask. But that's the problem, all right? That's why I believe somebody should consider infinite banking, is because the average American is bleeding out interest dollars that forever leave us and our families. Are you with me so far? Let me know. Now, again, if you're hearing this so far and you've not seen our introductory presentation to infinite banking, make sure to check that out. Put comments on there. Give it a like. Subscribe to our channel if you haven't subscribed to our channel. But that's the who, the what, the when. I mean, that's your question. You know, well, here's what I think about when. When did banking start? Let's think about these actors that I've kind of introduced. How long's banking been around? It's been around forever. Banking's been around forever. It's just a process. It's just a concept. It's just a function. It just exists, right? Like we're doing it. We're just not doing it for ourselves until we start infinite banking. All right, so that's the relevant when it comes to banking. How old or how long have life insurance companies been around? I've also already answered that. You know, one of the oldest financial institutions that there are, okay, especially here in America, but throughout the world. And then, well, when did infinite banking start? Because if whole life insurance has been around for hundreds of years, and if banking's just always been going on, well, the next relevant when is, well, R. Nelson Nash. See, back in the 80s, this man had some life experiences that just made him awaken to the concept that he could become his own banker. And over the next couple of decades, he implemented that concept into his own life. And then around 2000, he codified it and described it and laid it out for all of us in his book, the book called Becoming Your Own Banker, so that I could read it and you could read it and we could implement this concept for ourselves. And he gave live seminars on it. So the idea of becoming your own banker has been around for, 4+ decades, around 4 decades or so. And I personally benefit from that concept. Never got to meet Nelson. I personally know people who did personally know Nelson, which is pretty cool. That's the next best thing for sure. But that's the relevant when I would say about infinite banking. Realized in the 80s, discovered in the 80s by Nelson, implemented in his own life, and then he taught it ever since, wrote about it. Now he's actually got a second book. If you've never read Building Your Warehouse of Wealth, I would encourage you to check out Nelson's second book. That's called Building Your Warehouse of Wealth. And then he actually has a ton of suggested and recommended reading in the back of Becoming Your Own Banker that I would encourage you to check out as well. So that's the who, the what, the when. Where? I mean, where infinite banking can be implemented is infinite. I mean, we work with clients here in the United States, of course. I'm a licensed insurance agent, but I just do this one thing, right? I help people become their own bankers. I help people start a private family banking system and coach them in that and cheerlead them in that and share best practices all across the U.S., right? So where? And I've given some examples of of where IBC has been applicable in our lives, from paying off debt to real estate to business endeavors to normal things like paying taxes or having a family vacation or whatever. So the who, what, when, where, why brings us to how. Again, that's what we're here for. And that's my alarm going off right now. I've got a client call right after this. So a good time for y'all to put in questions and us be able to get you any answers to questions that you have. I've got phone calls today still. We've got an introductory presentation for you to check out. This book, you need to get a hold of Becoming Your Own Banker. You need to check out Nelson's second book, Building Your Warehouse of Wealth. You know, we're on YouTube, podcasts. We do free private consultation calls where we talk about your goals, your plans, your dreams, your aspirations, your questions, what it would look like for you to implement infinite banking into your own life, your household, your business, whatever it is that you're all already doing. It's just considering adding one step to that, adding one step to what you're already doing. You're already banking, but not with our own bank and not being the banker ourselves. So we don't have the control. We don't have the profitability, but it's adding one step to what you're already doing. And just like it was told to me back in 2016, when I was first, pulled out of the matrix and made to see this, you don't have to work any harder. You don't have to change your cash flows. You don't have to take any additional risk. You don't have to lose control. You just add that one step to what it is that you're already doing. Jake, you're talking about in the comment section, and I appreciate that. Walt Disney used insurance loans. He sure did. He used cash values against more than one policy to launch Disneyland, which was a novel idea at that time, a family-friendly, clean theme park. He had to get creative with the financing of it because everything is financed. And when he went to the banks and the banks didn't want to do it, just like my friends in Western North Carolina have been trying to go to banks and get cash money out from what they've put in to go out and take care of necessities. And the banks are the ones in control saying, And there are lots of other great examples. It's worth a look at the history for sure. J.C. Penney paid for his overhead during the Great Depression using whole life insurance. Miss Christopher launched her Pampered Chef. My wife loves that company. Bought all kinds of stuff from that company. Miss Christopher launched the Pampered Chef, which Berkshire Hathaway, Warren Buffett's company, bought. She launched her company, her business idea, with cash values from whole life insurance, leveraging her whole life insurance policy. And then so many other examples for sure. Good example. I love that. Thanks for bringing that up, Jake. But I just wanted to present the who, what, when, where, why, and how of infinite banking. If this has been helpful, I'd love to hear that from you in the comment section. If you haven't had a consultation call, feel free to book that using links to calendars. Watch our introductory presentation if you haven't seen that. I've put all the resources, at your disposal, just like it was given to me. Somebody made a presentation of an idea, asked me to consider it for myself, asked me to pursue it further if I was inspired, and I was. And at the end of the day, like James Nethery says, it's all conversation though, until somebody writes a check. When you're a little kid, and you're seeing other kids out in the neighborhood having a good time, riding their bikes. That's what it was for me. Couldn't wait to ride a bike. And I've enjoyed teaching all of our children so far. It's time for my little girl. It's time. But I've helped both of our boys get started riding a bike as well, right? There's just this point where you've watched everybody else have fun long enough. It's real. It's happening. It's just a matter of you haven't experienced it for yourself yet. Now, there are a lot more guarantees that you're not going to fall down and scuff your knee, right? Like I'm describing with a bike. But I think you can understand the analogy. There's nothing like riding a bike for yourself. You feel the wind in your face. You feel the control. You have the fun of doing that for yourself. There's something about, when the rubber meets the road, you implementing the concept for yourself. The idea is for you to become your own banker. So this has been a great pleasure for me. I look forward to our next conversation. Appreciate you guys for being here. Have a great day. Take care.